Hello everyone. In this video I'm going to walk through the topic of managing bond portfolios. It's topic 9 for our course. And at the end of this there'll be another video that goes through an Excel workbook where I'll demonstrate how to immunize a bond portfolio, and you're going to use that for your next assignment. So in this topic we're going to go through how to manage portfolios of different bonds, and really with the goal of managing interest rate risk and managing the risk of the value of the portfolio of the investor's portfolio that might occur due to a change in interest rates. So changes in bond prices are inversely related to changes in bonds yield to maturity. So in other words, when the yield to maturity increases, or the required rate of return on that bond increases, the value of the bond decreases. The opposite is also true. Whenever yields to maturity decrease, the value of bonds increase. So whenever the government drops interest rates, if the yields on corporate bonds fall with those as well, the value of those bonds are going to increase. So if the yield to maturity increases, then investors will reduce what they will pay for the bond so that their return from the coupon payment and the amount received at maturity will be equal to the new yield to maturity. And we're going to work some examples of that later on. Likewise, investors will pay more for a bond today if the yield to maturity decreases. So interest rate sensitivity. The following graph demonstrates the effect of a change in the yield to maturity on the percentage change in a bond's value. So what I have here is 4 bonds, A, B, C, and D. They have different coupon rates. A and B have a coupon rate of 12%. C and D have a coupon rate of 3%. Bond A has a maturity in 5 years, and the other 3 bonds have a maturity in 30 years. The initial yield to maturity for the first 3 is 10%, for the last one is 6%. The idea behind giving these parameters is that I want to show you which ones affect interest rate risk and in which direction. So down below, we've got bond A is just our regular black line here. Bond B is this dash and dot line. Bond C is this dash line. And then bond D is the dots. And so the question down below, what are the characteristics of the bond whose price is most sensitive to changes in the yield to maturity? Well, the bond whose price is most sensitive to a change in the yield to maturity is bond D. You can see here with a change in the yield to maturity, when the yield to maturity decreases, the value of that bond increases substantially. And whenever the yield to maturity increases, the change in the value of the bond decreases somewhat. There's a greater effect whenever the yield to maturity decreases than when it increases for bond D because of the time to maturity and the initial yield to maturity. So to answer our question down here, what are the characteristics of the bond whose price is most sensitive to changes in the yield to maturity? Well, first of all, it's bond D. So what are its characteristics? It has a low coupon rate. Long long time to maturity. And a low initial yield to maturity. Okay. And we're going to get into this more. This low coupon rate is a big factor affecting the interest rate risk, because what this means is that more of the value of the bond, or more of the return of the bond, occurs over time whenever we get the par value at maturity. So it's sold at a greater discount because the coupon rate is lower. The higher the coupon rate, the lower the value of that bond's sensitivity to a change in interest rates. The longer the time to maturity, and we'll go through this again, but the longer the time to maturity, the greater the interest rate sensitivity, and then the lower the initial yield to maturity, the higher the interest rate sensitivity. of the bond. What are the characteristics of a bond whose price is least sensitive to the changes in the yield to maturity? The least sensitive bond here is Bond A. It has the lowest amount of price movement. Bond A has a high coupon, a low maturity in years, and a high initial yield to maturity. Sorry about that. Maturity, there we go. So, bond price sensitivity to changes in interest rates are driven by the 6 following properties. Bond prices and yields are inversely related. As I mentioned before, as the yield to maturity increases, the value of the bond decreases, and vice versa. An increase in a bond's yield to maturity results in a smaller price change than a decrease in the yield to maturity of equal magnitude. And that's what we saw up in that graph. Prices of long-term bonds tend to be more sensitive to interest rate changes than prices of short-term bonds. The sensitivity of bond prices to changes in yields increases at a decreased rate as maturity increases. Interest rate risk is inversely related to the bond's coupon price. Coupon rate. Prices of low coupon bonds are more sensitive to changes in interest rates than prices of high coupon bonds. And we're going to see the extreme of this when we look at zero coupon bonds. Zero coupon bonds have the highest interest rate risk. The sensitivity of a bond's price to a change in its yield is inversely related to the yield to maturity at which the bond is currently selling. So the question down here is, how does the sensitivity of the price of a zero coupon bond with 30 years to maturity and an initial yield to maturity of 10% compare to the bonds above? It's going to be higher than any of the bonds above. We're going to work an example of this later. And this is essentially because it has a zero coupon rate. So there's no interim payments during the life of the bond. And so that increases the interest rate risk. Additionally, the yield to maturity is high compared to the 6% down here. And it's equal to the yield to maturity on all the other bonds. So that zero coupon bond is going to be more sensitive. The price of that bond is going to be more sensitive to changes in interest rates than the other bonds up there. So the next measure we're going to talk about is duration. I'm going to show you how to calculate it by hand, but what I'm going to actually have you do is calculate it using Excel, which is much easier, and I demonstrate how to do that in the next video. Duration is a measure of a bond's price sensitivity to changes in interest rates. Macaulay's duration is the weighted average of the times to each coupon or principal payment. The weight associated with each payment is related to the importance of the payment to the value of the bond. It's calculated as 1 divided by the price of the bond multiplied by the sum of the time period multiplied by the cash flow for that time period divided by 1 plus the yield to maturity raised to the power of t. And that yield to maturity is going to be the periodic yield to maturity. So, for example, if a bond makes 2 payments per year, we're going to take the rate for 6 months rather than the rate for the entire year. in that calculation, and I give a demonstration of that below. Where T is the time period in years from the present, CFT sub T is the coupon payment or payment of principal at time T. P is the price of the bond today, and Y is the periodic yield to maturity. So the example I have down here for you is, what is the duration of a bond with a coupon rate of 6%? It makes semi-annual coupon payments, has 3 years left to maturity, and the current yield to maturity is 8%. And here I work through the calculation for you. It is the price of that bond today. It's going to be $947.68, and then $30 is the cash flow that we get every 6 months. Because the yield to maturity is 8%, the periodic rate every 6 months is going to be half of that, or 4%. And then the time period, we just go 1, 2, 3, 4, 5, and 6. So there's 2 payments per year for 3 years. Since this is a semi-annual bond, we divide the result by 2 to get the duration in years. So this is the duration for 6-month periods. So it's 5.566 6-month periods. Because we want to put that into years, we divide by 2. We get a duration of 2.783. What is the duration of a zero coupon bond with a yield to maturity of 8% and 3 years left to maturity? So the difference between this bond up here and this bond down here is that there's no coupon payments. So that's why we're not taking a periodic every 6-month rate, is because there's no coupon payments. So there's no reason to take that 6-month interval. So it's the same length of time, same yield to maturity. So in this case, we're going to take the price of that bond today, which is going to be $793.83. Our cash flow at time 1 is 0, because it's a zero coupon bond. So we're going to just divide 0 by 1.8 to the first, which is 0. And then the time 2 cash flow is 0. So we're going to multiply that 2 times 0 divided by 1.08 squared is again 0. And then we receive our $1,000 at maturity. Again, this is the par value is $1,000. And so we 3 times 1,000. We divide that one by 1.08 to the third. Then we take the value we get for this, divide it by 793.83. We'll multiply those together, and we get an answer of 3. So one thing to know, our rule 1 down here is the duration of a zero coupon bond equals its time to maturity. So there's a 3-year time to maturity for this zero coupon bond, and its duration is equal to 3. Holding maturity constant, a bond's duration is lower when the coupon rate is higher, so it has less interest rate risk. Bonds with higher coupon rates have lower interest rate risk, holding all else equal. Holding the coupon rate constant, a bond's duration generally increases, so the interest rate risk increases with its time to maturity. Duration always increases with maturity for bonds selling at par or at a premium. That may not be the case if the bond is selling at a discount, especially a deep discount. Then number 4, rule 4 says, holding other factors constant, the duration of a coupon bond is higher when the bond's yield to maturity is lower. Rule 5 is that the duration of a level perpetuity is 1 plus the yield to maturity divided by the yield to maturity. So, for example, if the yield to maturity is 8%, then the duration of the perpetuity is 1.8 divided by 0.08 is equal to 13.5. So remember, a perpetuity is a bond or a debt that does not mature. So duration gives us, we can use duration to get an approximate change in value due to a change in the interest rates. There's a formula. I decided not to include it in these notes that used to be used quite a bit, and the idea of duration used to be used quite a bit to determine what would happen to bond prices with a change in the interest rate. But that was developed many decades ago, and the reason why it was used is because there's a lot of calculations involved with determining the change in the value of a bond due to a change in interest rates, and so it was very fast to use this approximation. Nowadays we have high-powered calculators, we have Excel and other worksheet programs that can do these calculations for us very simply and very easily, and that's what you're going to actually do some of in your assignment. So convexity was a way to actually improve the approximation of the change in value due to a change in price. Duration is used as a measure of the interest rate risk and to estimate the change in the price of a bond with a change in interest rates. Convexity measures the actual change in price due to a change in interest rates. So the example in this graph says that convexity for a 30-year bond with an annual coupon payment and a coupon rate and existing yield to maturity of 8%. So in this case, the coupon rate and the yield to maturity are the same. So the initial yield to maturity is equal to the coupon rate, and so it's selling at par value whenever the bond is issued. With a change in the yield to maturity, we can see what happens with duration. It's going to, the value of the bond is going to change using the duration estimate along this flat line. Convexity, this is an actual, represents the actual change in the value of the bond. And so you can see here it's curved, it's convex. So convexity increases with the time to maturity, which means that this bend gets deeper. Okay? It gets more extreme with the time to maturity. For shorter maturity bonds, convexity isn't as important, and the modified duration estimate of a percentage change in price provides a fairly accurate estimate in the actual change in the bond price. So why do investors like convexity? So we can see here that if the yield to maturity decreases, the value of the bond goes up even more because of convexity. If the yield to maturity increases, the bond value goes down less with convexity. Duration and the convexity of callable bonds. And now remember, with callable bonds, the bond can be called and the investor would receive the call price, which is the par value plus the call premium. So, we might say in this case, since the coupon rate's $80, that they might get an additional coupon payment if the bond's called early. And so it might be, the call price might be $1,080. But that's the maximum value for the bond, because if the value of the bond goes up above that, then the company's likely to call that bond, because then they can just call the bond and reissue it at a lower rate. So at low interest rates, callable bonds have negative convexity. That is, the value of the bond ceases to increase as the bond value is limited to the call price. If rates fall sufficiently to raise the value of the bond, if it were not callable above the call value, then the firm would likely call the bond and issue it at a higher price. What that means on this graph here is that as rates drop, the likelihood of a bond being called increases, and at a certain point, a company, as long as they're acting rationally, will go ahead and call that bond. So this curve would look the same to a certain point over here on the left-hand side. So if the value of the bond, if the yield to maturity for the bond drops enough, then this curve is just going to go flat. Okay. So it's going to go up, and then it's going to have a kink in it, and it's just going to be flat over here. Because at that price, at that rate, the firm will go ahead and call that bond, and the investor won't see any additional increase in value from the yield to maturity falling. So passive bond management. Bond managers tend to accept bonds as fairly priced and tend not to seek out undervalued bonds. And, so the thing about bonds relative to stocks is that the yield to maturity is the required rate of return for that bond that's set by the buyers and sellers in the market. So when you find the bond quotes, they're going to show you the required rate of return for that bond, which is something we don't have with stocks. So bond pricing is very transparent. They tend to be priced based on their yield to maturity. Any special things about them, like if they're callable, if they're puttable, if they're convertible, if they are secured with specific collateral, usually a mortgage on real estate, and then of course the bond rating for that bond. So it's fairly easy to see, if the yield to maturity is accurate. And so most bond managers do accept bonds as being fairly priced. So they engage in passive management. They're not trying to find undervalued bonds. So there's two approaches to passive bond management. The first is replicating a bond index, which is very different than replicating a stock index, or immunization, which is removing or decreasing the interest rate risk of a portfolio. So replicating a bond index means that bond managers select bonds to replicate returns of a given index. Immunization portfolios are designed to shield the overall financial status of the institution from exposure to interest rate fluctuations. Immunization is commonly used by insurance companies, pension funds, and other financial institutions. And we're going to work through a kind of a big example of this later on. I'm going to show you the example in these notes. We're going to work through a little bit of it, and then in another video that I've made, I work through the entire example. Immunized portfolios are constructed to establish a virtual zero risk profile so that interest rate movements have little, if any, effect on the value of the firm. So the goal with immunization is to get an outcome, a dollar amount outcome that we desire, and eliminating most of the interest rate risk associated with getting that outcome. Bond index funds. Like stock index funds, bond index funds are constructed to mirror the composition of a broad market. However, due to differences in the way that bonds are traded, buying a small amount of each bond being represented would be costly and difficult. So remember that bonds are not traded on an exchange. They're traded with dealers. So if I want to buy a bond, I'm going to buy that bond through a dealer. The following is a list of difficulties in constructing a bond index from small amounts of each bond in a broad market. So indexes consist of thousands of bond securities. Some firms have several bond issues outstanding, and I pulled up here. So this is on Capital IQ. And I went to Walmart's fixed income security summary. So this is going to show all of the bonds that are outstanding for Walmart. If you look down here, they have 47 different bonds outstanding. So while there may be one issue of Walmart common stock, so if you want to own Walmart stock, that's what you own, there are 47 different securities issued for their debt. Many bonds are thinly traded, meaning there's not a lot of buyers and sellers, and that kind of makes sense. If I want, I just showed you Walmart, they have 47 different bond issues. So there are a lot of different bonds out there for the different companies. So there's not investors that are interested in buying every bond that a company owns. So they tend to be fairly thinly traded. So it may be difficult to buy the bond and sell the bond when needed. So this is a lack of liquidity here. What that means is that if I went out and I was creating a bond index and I bought all of the bonds in the index, when it's time to sell those bonds, I might have a difficult time selling those bonds the current value of the bond, because there might not be someone on the other side of that transaction who's willing to buy it. So the bond dealer may buy it at a deep discount, or a fairly deep discount, because he or she may not know that there's another investor out there wanting to buy that bond. It's difficult to rebalance a bond index fund. If a bond falls below 1 year to maturity, it is often dropped from an index. Anytime a new bond is issued, it would need to be added to the index. So again, difficult. There's so many bonds out there, so many companies issuing bonds, that it's difficult to replicate an index. Bonds generate considerable interest income, which has to be reinvested back into the bonds in the current proportions. To overcome these problems, bond managers use a cellular approach in which they match the risk characteristics, such as industry, time to maturity, and coupon rate and credit risk of the overall bond index with a representative sample of bonds. The other thing we're going to talk about in more detail is immunization. Immunization is used to protect the value of an organization today, or the future payment that an organization needs to make or receive in the future from interest rate risk. Fixed income investors face two offsetting types of risk: price risk and reinvestment rate risk. So what I've been referring to as interest rate risk is this price risk. It's the risk that interest rates will rise and will decrease the value of a bond. Reinvestment rate risk is the risk that the interest rate will fall, and so whenever investors receive coupon payments or they receive the par value at maturity, they won't be able to reinvest at the same rate or higher than what they're already getting, that the rates have fallen and now their returns are going to fall along with that. In an immunized portfolio, the price risk and the reinvestment rate risk cancel each other out. If the portfolio duration is set equal to the investor's horizon date, the accumulated value of the investment fund at the horizon date will be unaffected by interest rate fluctuations. And again, we're going to work through an example of that. The simplest approach is to purchase zero coupon bonds with a maturity date equal to the date the funds are needed by the investor. So with a zero coupon bond, if I need $1 million in 3 years, I can buy a zero coupon bond that pays $1 million in 3 years. And what I'll pay for it today is the price of that bond today. There's no coupon payments, nothing to reinvest. And then at maturity, I get my $1 million that I need. However, there may not be a zero coupon bond that has a maturity near the time needed. Also, zero coupon bonds may not provide as high of a return that the investor desires. So here's an example, and I work out the entire example in the next video, which goes through and creates this worksheet. I'm going to work a few of these by hand, or I've worked a few of these by hand to show you how it works. So the example here is that you need to have $1 million in 5 years to make a required payment on a contract. Your options consist of a zero coupon bond, so you could buy this bond today, this first one, zero coupon bond. You're going to buy 1,000 of these bonds that have the price at maturity or the value at maturity, so its par value is $1,000, and then you don't need to do anything. It matures in 5 years. That's when you need the money, so you'd invest this amount today based on the existing yield to maturity. And so I'm going to work these problems in Excel. You're feel free, and I show you some inputs down here on how to work these using a calculator. So I'll just open a new spreadsheet here. There we go. So I'm going to work these in Excel just to demonstrate how it works. So just to get this zero coupon bond, I'm going to put equals, and because I want my outcomes to be positive, I'm going to make it negative. So equals negative, present value, the rate is 6%. That's my current yield to maturity right up here. My number of periods is 5. My payment is 0 because it's a zero coupon bond. My future value is 1,000. And then I'm not going to worry about that type. That type is important if you have an annuity due. But for all these problems, they're going to be regular annuities. And actually I need to put in not 1,000 but 1,000,000, and I get the 747, 258, 17. And you'll notice that all of these have the same invested amount because they all have the same current yield to maturity. In your homework assignment, I changed this because they all have different times to maturity. And so they're going to have different levels of risk and different, hopefully different yields to maturity. And so in your assignment, and I give pretty explicit directions on your assignment to explain what's going on. But essentially, we're going to assume that changes in the yield to maturity are the same across bonds, but that they don't have all the same yield to maturity. So you can see a more realistic example and work through a more realistic example of that. So what is the value of the bond in 5 years? So the example we're going to work here is bond 2. So bond 2 has a time to maturity in 7 years and a duration of 5.80. And I show you how to, in that video, how to calculate that in Excel. It's just an Excel function called duration, and it calculates it for you. So the first question with bond 2 is, what is the value of the bond in 5 years if the yield to maturity is 5%? So I say here n is equal to 2, and you might ask why. Because we want to know the price 5 years from now. And in 5 years, that bond only has 2 years left to maturity. So it has 2 years left to maturity 5 years from now. The interest rate is 5% because we're using the new yield to maturity of 5%. And we're looking for the present value in 5 years. So the payment is $69.90 because that is the coupon rate, 6.99% multiplied by 1,000. The future value is 1,000, and there's one payment per year. So we put that in, and I'll go ahead and do that here in Excel. I'm finding the present value with a rate of 0.05. A number of periods is 2. The payment is 69.90. The future value is 1,000, and I forgot to put that negative number, that negative sign at the beginning of the function here, so I'll go ahead and put that in, and I get $1,037. So that's my answer here. So the value of that bond 5 years from now, what I can sell it for, is $1,037. Next is the tricky part. Because I've been receiving this payment of $69.90 for 5 years now, during those 5 years, hopefully I've done something with it. We're going to assume that I've reinvested that at the yield to maturity, at the new yield to maturity of 5%. So 5% is my reinvestment rate. So now I want to determine, I've received these payments for 5 years of $69.90, and now I should have cash from those investments as well. So how much is the value of that cash? And so this is going to be equal to the future value. The rate is 5%. The number of periods is 5. The payment is $69.90. And we're actually looking for, there is no present value because we're receiving that. Well, we didn't receive anything to begin with. Okay. And so the future value of my 5 payments of $69.90 invested at 5% is $386. Oops, it went off the screen here, and 24 cents. So I'm going to add those together to get $1,423.24. Right up here. So the value per bond in reinvested coupons at the new yield to maturity, right here, 5% in 5 years. So again, what that means is that this is the value of the bond at year 5. And this is the value of the reinvested coupons at year 5. So at year 5, at the end of, well, at year 5, the total value from that bond is $1,423.24. And that's what I have down here. The value of the bond and reinvested coupons in 5 years is $1,423. And I apologize, there's a mistake there. It should say 0.24. Which of the bonds has a duration closest to the maturity date? So the one with the duration closest to the maturity date, not including the zero coupon bond, is bond 1. So it is 0.58 from the duration of 5, which is the duration for the maturity date. The payoff of that investment, if the yield to maturity falls to 5%, is $1,370.22 per bond. Sorry about that, I pulled up the wrong sheet. There we go. This is bond 1. So if the yield to maturity falls, and we're saying it falls on the, today, on the date that you initially invest, the value of that bond and reinvested coupons at year 5 is going to be $1,370.22. And I purchased, the number of bonds purchased today would be 725.86. And so the total value, the total payoff, would be $994,587.89. Okay. So what is the payoff of the investment if the yield to maturity increases to 7%? And again, we're saying it increases at the beginning of all this, at the beginning of, at time 0. Okay, so you might pause the video now and work through it. It would work the same as what we've done up here. I don't have the answer to this in this table. And so take a minute, pause the video, and then I'm going to work out how to answer this question. So here's the answer. The value of the bond at year 5 So this one's pretty easy because this bond matures in 5 years. So the value of the bond at year 5 at the end of that period, I don't have to do any calculations. It's $1,000. The value of the reinvested coupons, and well, let me just stop and it's easy for me to say it's just $1,000. I'm just going to demonstrate it to you. This is equal to the present value. The rate is the 7% because remember it changed to that. The number of periods is 0. The payment is not really relevant, but the payment on this bond 1, is going to be $67. The future value is $1,000, and then we would make that negative to give us a nice positive number. There we go. It's $1,000, okay, because it's at the time of maturity. Now the value of the reinvested coupons is what's going to matter here. Again, this is equal to, I'm going to put in negative future value. My rate is 7%, and because that's the yield to maturity changed to that, so that's what it would be. The number of periods is 5. The payment is $67. The present value is 0. And so it's $385.30. So the total value at the maturity date is $1,385.30. Our total payoff is going to be equal to that number multiplied by the number of bonds that we purchased. We purchased 725.86 of the bonds to get a total payoff of $1,005,533.50. So our total payoff here is $1 million. All right. So would you prefer that bond to investing in the zero coupon bond? That's a tough question. So if the yield to maturity falls from 6 to 5%, then we're not going to have our money that we need. We're not going to have $1 million. If it increases to 7%, we're going to have a little bit more than what we need. We're going to have $5,533.50 more than what we need. If my goal, though, is to get $1 million and to have $1 million, I don't want to take the risk of coming up short. So for me, I would not prefer that bond to investing in the zero coupon bond, because I'm taking a risk that I'm not going to achieve my goal of $1 million. So to create an immunized portfolio, we can solve for the weights that would result in a bond portfolio with a duration equal to the time to when our money is needed. And so I do this in the Excel video, and I show you how to calculate these weights. And so I did that here. I combined bonds 1 and 2. In the first portfolio here. So we would put a weight, and it's based on the duration of each of the bonds, a weight of 0.5811 in bond 1. So I'd take 58.11% of my money and put it in bond 1, and 41.89% and put it in bond 2. Together those have a duration of 5 in that weighting scheme. And then if I were to combine bonds 1 and 3, I'd put 90.18% in bond 1 and 9.82% in bond 3. And notice that these sum to 1 when I add them up. And that would also give me a duration of 5. So would I combine bonds 2 and 3? And I wouldn't, because here's the problem. So I can combine bonds 1 and 2 because bond 1 has a duration of less than 5. Bond 2 has a duration of more than 5. I can combine bonds 1 and 2, or excuse me, 1 and 3, because bond 1 has a duration of less than 5, and bond 3 has a duration of more than 5. I can't combine bonds 2 and 3 because I can't take a negative position in these bonds. I can't kind of sell them short. So any combination of these two with positive weights would result in a duration of greater than 5, because neither of them have a weight, or excuse me, a duration of less than 5. Okay, so I can't combine these two. Once I do that, and again, I'm going to show you how to calculate this in Excel in the next video, I get 3 portfolios. Well, I get 2 portfolios and a zero coupon bond. So you see here the zero coupon bond, there's no change in value with a change, or no change in ending value, ending portfolio values, with a change in the yield to maturity. I get the same outcome of $1 million because there's no coupons. I bought it at a discounted value to the par value. It increases to the par value during the life of the bond. And so the value of that bond at maturity is the same no matter what happens to the yield to maturity. Portfolio 1 is the dashed line. You can see here that there's some convexity. And so we begin with a yield to maturity on all of our bonds here of 6%. As the yield to maturity increases, the value of that portfolio also increases. As the yield to maturity decreases, the value of that portfolio also increases. So if I'm an investor and I'm looking to meet a goal of $1 million, I know that the combining bonds 1 and 2 in the proportions I have above will result in a return, or in an ending portfolio value of at least $1 million and likely more. Portfolio 2 is a combination of bonds 1 and 3. And again, and this is even more convex, so there's a greater change in price, positive on both sides, with a change in the yield to maturity. So which option has the greatest convexity? And that's portfolio 2. And again, no risk. that the values of the portfolio will fall below between that magic $1 million number. So which option would now be the best option? In my opinion, it's portfolio 2, because more money is better. You can see here it's not a lot more money, but it is an outcome where we come out ahead with a change, either positive or negative change in the yield to maturity. So again, portfolio 2. Right. So that covers passive bond management, creating an index for a bond index, or following a bond index, or immunization. Okay, so that's passive management. Active bond management. So this is a situation where the bond managers are trying to find an additional return, and not necessarily assuming that the value of the bonds is efficient. So there are two major sources of profit for bond traders. Potential profit for bond traders. The first is interest rate forecasting. If you expect interest rates to rise, you would want to decrease the portfolio duration. Because with a decreased duration, with a raise in the interest rates, the value of that portfolio is going to increase. If you expect interest rates to fall, you want to increase the duration of the portfolio. Now here's the key thing. This only works if you are able to anticipate a change in interest rates that isn't already expected in the market. So this would mean that to a certain extent the bond markets are inefficient, that they don't recognize a higher potential for an increase, or excuse me, a higher potential for a change in interest rates. The second one, finding mispriced bonds. If the yield on the bond doesn't accurately reflect the risk of the bond, then you can achieve superior returns trading in that bond. Profits can be achieved on mispriced bonds through substitution swaps, exchanging one bond for a nearly identical substitute with an equal coupon, maturity, credit risk, and call features, and an intermarket spread swap, looking for spreads between bond classes that aren't explained by risk differences, and swap bonds between classes to produce profits when yields are corrected. And then rate anticipation swap. This is related to interest rate forecasting. If you believe that rates are going to rise, then you'd want to swap into shorter duration bonds. For example, you might sell a 25-year duration treasury bond and purchase a 5-year treasury note. So that would shorten the duration of your portfolio by going from a 25-year duration bond to a 5-year note. And then finally, the pure yield pickup swap. This swap takes advantage of an upward sloping yield curve by swapping out a shorter maturity bond with a longer maturity bond. The investor will receive a higher yield as long as yields don't increase. So along this line, again, I love the movie The Big Short. The idea in that movie is that, in a way, the protagonist found mispriced bonds because the bond market was not recognizing the risk associated with the mortgage-backed securities. So those are a form of bonds. And rather than trading in the bonds themselves, the protagonist purchased insurance, referred to as credit default swaps. And that insurance was also mispriced because it should have been priced at a lot higher rate because of the riskiness of the bonds. But the investment banks that issued those credit default swaps didn't recognize that. And so he was able to buy that insurance for very, very little and then take advantage of it whenever those bonds went into default. So again, I'm going to put out along with this another video walking you through how to calculate everything in this table up here and how to work your next assignment, which is a bond immunization assignment. If you have any questions about any of the calculations on here, if you'd like me to do some more examples, just shoot me an email. Let me know. Let me know if some of the calculations didn't make sense. I'm happy to go over them. I'm happy to tape another video showing, how to do this in a calculator. whatever you need, please let me know. And I will be putting out some quizzes along with this, and then the other video demonstrating how to calculate this table in Excel. All right.